Hi, everybody. Just wanted to remind you, please smash that like button, hit subscribe. Really helps to get these videos out. I noticed that I'm getting a lot of views, which is fantastic. But I just want to see those subscriptions coming up and the likes really helps a lot. So appreciate it. Smash that like at the end of the video or just right now while I'm blabbing on and before I get into the material. Thank you, everybody. Hey everybody, I wanted to make a relatively short video just explaining the basics of options and options trading. I know for a new investor, I didn't have a clue what options were. It took me a long time to figure it out, a lot of reading, a lot of watching videos, and there's still a lot of intricacies to it that I don't fully understand, to be quite honest. So I'm going to do a quick video explaining the basics of it. There's lots to learn on options. It's a major part of investing and trading. It's more of the gambling side of the stock market, I would have to say, just because you're not really owning a stock or a part of a company. You're gambling on where stocks will go up or down and profiting off that. So um, let me start by going over to Investopedia. And sorry for my slow load times. My internet is not the best in the world. So right here, Investopedia gives a basic introduction to buying and selling options. There are two main types of options. They're called calls and puts. A call is when you're able to call a certain amount of shares to you using a contract, an options contract. And a put is when you put your shares up for sale at a certain price. So options aren't actually physical pieces of a company. They're not shares. So when you buy options, you're giving yourself the option to buy or sell shares at a certain price. They're like a coupon that you hold for a certain price, and you can sell that coupon if someone else wants to use it instead of you. So, for example, I want to go to KFC and buy a big crunch, and I buy a coupon that gives me a big crunch for $5. And that's a great deal. So I buy the coupon. But at the end of the day, I don't really want a big crunch. Um, but the price of big crunches is going up. Now they're $12 for a big crunch. So that coupon becomes very valuable. The price started at $10, and then a week later, KFC jacks their chicken prices, and now they're $12.50 for that big crunch. So that coupon just became more valuable, and I can sell it to someone else, maybe for $7.50, maybe even for $10, and they'll buy it from me because now they can take it to KFC and use that coupon. But the trick with options is there's an expiry date, just like a coupon. So that coupon expires a week later, so they have to use it within that time frame. So when it comes to options, these coupons are in lots of 100. So one options contract is for 100 shares of a stock. So you can either buy 100 shares at a certain price called the strike price, or you can sell 100 shares of a stock at a certain price. So remember again, buying, they're called calls, and selling are called puts. And so this little box here on the screen gives you that basic definition of buying and selling options. If you go a little further down, they'll say options are derivatives. So in other words, they're derived from the stock price. They come from the stock price. And why they're derived from it is, think about it this way. If a stock price goes up $1, then and a contract is worth 100 shares, well, often an options contract that you buy can go up 100 times the price of the stock in the same amount of time. So they can be very lucrative. On the same token, if it goes in the opposite direction of what you bet, for example, the price of big crunches goes down and they're $4, well, my $5 coupon is worthless. No one's going to want to buy a coupon to get a big crunch at $5 when they can go out and buy it at KFC for $4. So options are like that as well. So if the price doesn't change in the direction you hope, in other words, for a call, you hope it goes up so you can sell that coupon, that contract, and make money because it fixes the price at a lower rate. Or if it's a put, you're hoping the price goes down because you want people to buy your coupon so they can sell their shares at a higher price. And if the price that they could sell it for in the market is lower, they'll buy your coupon so they can sell it for higher. And that's the basics of stock options. So the calls and puts are described here. I'm not going to read this all to you. I know some YouTubers, they like to read the document to you. I believe you can find this yourself. Investopedia, really great resource just for investing in the stock market in general, and they will describe it here. Let's take a look at another site. It's called Options Profit Calculator. And this is just a fantastic resource if you're thinking about getting into options, because you can find the type of option, plug in the stock you're looking at. It will give you the current prices, and it will tell you how much you could make or you could lose based on how many contracts you buy. So, again, I forgot to mention, you can buy any number of contracts, from one contract for 100 shares, 10 for 1,000. It's almost unlimited. So you can buy these contracts from the market makers, and then if it's a call option, you can exercise that option yourself. In other words, use your own coupon, go to KFC, get a big crunch. You can exercise this before the expiry date and get those shares yourself. The trick is you're paying for the coupon, not the shares. So you still have to buy the shares, but the price you paid for the coupon will give you a discount. And that's the trick of it. Now, you don't have to exercise these options. That's why they're called options, right? You have the choice. So you can sell them to someone else. And that's what most options traders do. They will buy the option. When it goes up in value, they'll sell it to someone else who will use it, often the market makers. So that's the business of options. So here is the options profit calculator. And you'll notice at the top of the screen, it gives a whole pile of different kinds of options. There are basic options on the left-hand column. There are options spreads, advanced. There are so many different ways to buy and sell options. Most of these involve buying and selling different types of options at different strike prices all at the same time, and it gets fairly complicated. I'm not going to go into it in this video, partially because I don't know as much about it as I need to, and also just for time. I want to keep this really simple because you can trade options without knowing any of these advanced strategies. The basics are a long call and a long put. And so those are basically saying, I think a stock price is going to go up and I'm going to get a coupon for that so people can get a discount, or I think the price is going to go down and people may want to sell at this higher price and I'll hold a coupon for that, a put. When they talk about covered calls, that means you actually have the shares that could cover it. So for that option, a call option, you have the money to buy it. For a put option, you have the shares that you could sell if someone wanted to buy them. So if I look at the long call calculator, I have AMC plugged in here, and I'm going to show you what happens so I could put in the ticker. It will give me the current price, $26.10. When I click on select option, it goes over here to a list. And what you see are different expiry dates for these options contracts. Okay? So that's how that one works. All right. So when we look at this and we see the different expiry dates at the top of the screen, you'll notice the price will change as we click on these dates. So the closer you are to it expiring, the more chance someone's going to use it, the cheaper the prices are. And this price in the middle, the bold price, is called the strike price. So that's the price of the stock. So currently AMC is about $26.10. So it's close to this $26 level. So when you're looking at a call, these are the prices, These are the prices for each strike price. So what they have is the bid, the mid, and the ask. The ask price is what the latest sellers are asking for that contract, for that coupon. The bid price is what buyers have been offering to buy it for, and mid is just in the middle of those two. So if you look down at the price for what these options are, you'll see it's $4.47 is the middle price for this $26 call. Now remember, this price is the premium for one share. So what they're saying is you're going to have to pay an extra $4 premium to lock it in at $26. So really, you're paying $30.47. So that's going to be your break-even stock price for this being worthwhile. Now, what again you have to remember is it's 100 shares. So what you're going to do is move this decimal two places to the right, and what you're going to pay for this contract is $447 because you're going to get the price of 100 shares. Now you'll think, wow, that's pretty expensive considering I don't own the shares. And you're right. So it is a gamble. But keep in mind, when you buy it at that price and the stock price goes over that, over $30 in this case, you're going to start making the difference in stock price. For every dollar, you may make 150, thousands of dollars on top of what you paid for it. Let me show you a couple of examples. Okay, so we're going to go up and look at a little bit of a further expiration date. To me, I think a good strategy is always to buy your options contracts at a further out expiration date so that you have more time for that price to change. Now, when you do, though, it gets more expensive, right? Because there's more time, there's more chance of your bet coming through. Market makers make you pay more, so there's more of a premium. So notice that same $26 is now $750 or $750 for that option. Let's look a little further down. We're going to say, oh, the squeeze is about to happen. It's going to shoot up over $100 a share. So I'm going to buy it at a $70 strike price for $2.38. And I'm going to buy 5 contracts. Now you notice my total cost is $1,200, $238 multiplied by 5 contracts. That's what it is. So down here, you'll see the range of stock price. You can change that to whatever you want. So I'm just going to put $50, and then I'm going to say it's going to go up to 70, and then I press calculate, and this is where this program is so fantastic. It's going to give me sometime, it's usually pretty quick. It's going to give me a range of possible profits and possible losses. Now, this is for some reason going super, super slow today. It's usually really fast. There we go. Okay, so when I look down here, notice at the top, I'll see the dates all the way to my expiry date on the 18th. And then it will say, here is the price of the stock on the left. So if the stock price is $50 on, say, Tuesday, I'm going to make $4,000 if I want to sell it. So even though it didn't reach my strike price, because it still has a lot of intrinsic value, so there's value in this coupon because the price could still keep going up until it expires, I can already make that profit. So as long as it goes to $50. So there are prices obviously below. I could have set the chart to look at what would happen if the price stayed still, but really we know if it doesn't go over 30, our break-even price up here is $70. So that's what we need to get to before we make any cash. So as we look at this, if the price keeps going up toward our magic 70 before expiry, we can make $10,000, $8,000, $9,000 in profit before that time. Now, if it reaches expiry and it does not reach $70 though, I lose all of the money I invested, that $1,190 I paid for the contract. And if it stays in the lower range, notice that happens sooner, right? So if the price has to go up in the direction I'm gambling, it will. And so this chart will give you an idea. What if it goes higher than that? What if it goes over $100? So I'll put $75 to $100. I'll calculate it. Again, it goes a little slow. Loading. There we go. So look at what happens if it goes to $100 before expiry. If it happens earlier, because the coupon's still worth more and someone could resell it, it's worth more, right? $21,000 all the way to $14,000 at expiry. Now, keep in mind, you need to sell this contract or exercise it. And in this case, exercising it would mean you need to buy 500 shares at that price, right? At $70. So you have to have that kind of capital to do it. Otherwise, you want to sell this contract again, which is what most people do. Take these profits, then you could always buy the shares if you wanted to, right? So that's your choice when it comes to options contracts. You can buy those shares, or you can sell the contract and let someone else exercise it, and you take the profits from the contract. Okay, so we've looked at some AMC options, which right now AMC is really popular, going to the moon. So those options are pretty expensive. GameStop, even more so. Let's take a look at BlackBerry. So it's a little more reasonable, and sometimes you can get these options for uh, a penny or 5 cents per share. And so, in other words, $1 or $5 for an option. And that's where you can really heap up. BlackBerry's not quite so low, but if you look here, for this coming Friday, 17 cents per share or $17 for the contract. You can get quite a few contracts if you believe the price is going to go up significantly. Maybe you have a hot tip, maybe you have some information on the company that isn't factored into the options prices yet, and you feel strongly that that price is going to make a big shift up or down. And so you're going to gamble on these options contracts and grab as many as you can, right? And hopefully make a big profit. On the same token, you could lose it all, right? But the good thing about options, even though there is always risk, you can only lose as much as your contract is, right? So if I buy this contract and it's $17 and it goes bust at the end of the week, the price does not go where I think, I lose $17, right? So it's contained. Whereas the possible upside to that, if the price goes through the roof, there's no real limit how high a profit I can make. So that's why options are very attractive to people. Before I finish this up, let's just take a quick look at Questrade, the platform I use, and just take a look at how that works. Okay, click that. So here we have a stock price, of course, AMC, my favorite. But let's take a look at this options tab. So on the left-hand side, you'll see an options tab. Also up here where you have the ticker, if I type in AMC and I click option and enter, it should go over there. No, it didn't, but it should. Glitchy today. So if I click options tab on the left, though, it will do the same thing. And really, really slow today. My internet is not cooperating with me. I think all my kids are simultaneously going on it just to drive me crazy. There we go. AMC. Here we go slowly, maybe. Nothing seems to be loading. So that's fantastic. Okay, so here you have the AMC option I was trying to load. And you look at the strike prices here, and it goes all the way down. If I scroll down, $73. So you can bet that it's going to go either above or below those prices, right? So as you can see, because it's Sunday and the market's not open, there are no numbers in the bid and ask price, but usually there are, and you can just, they're hyperlinked, so you can click on them as the price you're willing to pay or buy it for, and it will open the buy sell window on the right hand side over here, and you can put how many options contracts you want. You can limit the price to whatever you're willing to pay, or you can buy it at market. And yeah, the same process to sell them when you're ready to sell. And as long as you do it before the expiry date, then you're good. And again, here are the expiry dates for AMC right now that are listed for June. So June 4th, 11th, every week, every Friday. Some stocks only have options contracts for every 2 weeks or every month, but AMC has a lot of them. And if you click over here, you will actually see more options dates available. So if I can click that there and zoom in, so you can see you can buy all the way into next year and the year after. So you can buy them pretty far out. Now, again, the more they're more expensive the further you buy them out. Less risk because there's way more time for that price to move up or down, but at the same time, you're going to pay for that insurance to have less risk. So the closer to expiry, the better the deal you'll get, but the less chance the price will move that dramatically. And the further out, there's a better chance, there's a better chance the price will move more dramatically because you have more time, but you're going to pay for that time. So it has more intrinsic value. Anyway, that's options in a nutshell. Drop me a comment. please remember to hit that like button, subscribe, share the video with others. And if you have any comments, questions, anything I messed up on, anything I can do better, or you just want to know more, hit me up in the comments and I'll do my best to answer you. Everybody have a great day and a very wealthy week ahead. Peace.